2, 1. We are live.
Good evening, everyone. We welcome you all to OrthoTV Financial Friday series in association with Nivesh Mitra. We have with us my very good friend, Dr. Sachin Kale, who's an avid trade investor, and he's a professor of orthopedics in D.Y. Patil Medical College and head of unit. We have with us the speaker, who is CA Arpita Gupta. She is the current director of NiveshMitra.com. It is a wealth tech company. By education, as everyone knows, that she is chartered accountant, has also finished her CFA level 1. She is working as a wealth and investment advisor to clients from varied backgrounds, and one of them is doctors. We had a session which was very popular last year with us on Anesthesia TV, and so we requested her that she take it dedicated to orthopedic surgeons as well. So with this, I hand over to CA Arpita Gupta to take over the proceedings.
Hi, thank you so much, Dr. Neeraj, for having us. Such a wonderful opportunity. And as you all know, we're talking, we want to talk about here common investment mistakes made by doctors. So just to give you a quick background, why am I relevant here and why have we chosen this particular topic is because, as Sir said, that, I'm working as a wealth and investment advisor. I'm heading NiveshMitra.com, which is a wealth tech company. And one of the very big niche clientele that we have here in Focused and Nivesh Mitra is doctors. So, majority of our clients are either doctors or Indian Army and Air Force veterans. And because me and my team are dealing with doctors to take care of their financial planning, investment goal planning, and investment needs, we could understand what mistakes generally doctors are making with their, financial planning, with their money, and with their investment issues. And that is exactly why we've designed this program to, bring out loud and clear that these are the common investment mistakes this community of doctors is generally doing with their investment decisions with their money, and what can you actually do about it. So it's going to be really less gyan, but a lot of actionable insights. A little quick background about our company, Nivesh Mitra. So it's a wealth tech company, and we help clients manage their investments and in their financial goal planning. So, if anybody wants to, save or plan for their retirement, generate a passive source of income, which is sufficient enough to take care of their monthly living expenses, or plan for their kids' education, marriage, all kinds of financial goals, or even just for, wealth creation or just general wealth generation kind of investment needs. We help clients, invest in the right asset classes and then actively manage it. And for asset classes, we deal in bonds, debentures, stocks, mutual funds, international equities, AIF, PMS, government securities. So that is why we are going to present you a holistic, unbiased opinion about all of these asset classes, when to go to which asset class, what should be the right proportion, what should be the way, you plan out your investments. And really proud to share and very happy to share that we are an Indore, Madhya Pradesh based company, but 80% of our clients are not based in Indore. So we're truly a wealth tech company. Our company is based around here. But because we are 100% paperless, we're truly wealth tech. We're serving clients across India. So, and a lot of them are doctors, like, 60-70% of them are doctors. And we're actually catering to clients even in Tamil Nadu, Haryana, Kerala, Karnataka, Madhya Pradesh, which is our hometown, Uttaranchal, Uttarakhand, Delhi, everywhere. So really humbled to share this with you all today. Okay, so coming to our topic today, risk for doctors. Long education period. When you compare to other professionals, doctors start with their professional career really much later into the life when you compare to other professionals. Hectic and unpredictable working hours, a lot of legal risks have started cropping up in this profession too. Doctors are known high-income professions, and with lack of time, that is why we see the highest rate of mis-selling of financial products here. And this is exactly why we're here. We're trying, even if you're a DIY investor, this is perfect for you, so that you have a base about what are the right investment choices, or what are the right ways of taking your investment decisions. And even if you're outsourcing your investment solutions or your investment planning to your agent or relationship manager, whoever, so you can at least take informed decisions, and you can make sure he's not working for his own commission or money, but your money is actually being deployed to the right asset class, and it is actually being used best for you. So the biggest question is that I get as an investment advisor is bank FD rates are at an all-time low. We are around somewhere 5.5% per annum. It has started rising, but again, it is really slow, and 5.5, 6 is still really low. And stock markets, again, very volatile. They've again reached around 58, 59,000 Sensex. So stock markets, again, around highs. Where should I invest my money right now? Is it too expensive to invest into stocks? Isn't it too risky? I'd rather invest into NPS. What are the investment options? Should I go for FD rates because, interest rates have started rising? So, we'll talk about, we'll start from the top. Now, talking about basics, how do you define low return and high return? What is the benchmark for returns? This is something, really important. Benchmark for returns is inflation. And we all know inflation is basically the rate at which your cost of goods and services is rising every year. Now, what is the inflation rate in India? In India, government periodically announces the inflation rate through CPI figure, and CPI is 6 to 7%. But we all tend to miss in that, education inflation, medical inflation, they're not included in it, which is almost, 60, 70% higher than this base figure. Education inflation applicable to all of us in the form of, our kids or grandkids education, or medical inflation, again, applicable to all of us. And you all know better than me that costs of treatment, hospital beds cost, they're all been rising at a really fast rate. Again, CPI does not include lifestyle inflation. What is lifestyle inflation? 50 years back, every house drove for clothing, shelter, food. 25 years back, every house started having a refrigerator, a television, vehicle of its own. And today, flight travels are much more common. Smartphones worth 50,000, 80,000, iPhones 1 lakh, iWatch, AirPods, air conditioners, laptops, they are so much more common. This is basically lifestyle inflation. Again, not included in CPI. So the inflation rate that is applicable to you and me in India is basically at least 7 to 8% per annum. Now, this is just a figure for you. 7 to 8% per annum is the inflation. What does it actually mean? Actually, it means that if inflation is at 7% per annum, that means every 10 years to maintain your standard of living, you're going to have to shell out double the money. So if today your monthly living expenses are 30,000 per month, after 10 years, to maintain the same standard of living, you're going to have to shell out 60,000 rupees every month. So, every 10 years to buy the same basket of goods and services, your cost will double every 10 years. That means this is basically inflation at 7% per annum. And that is actually applicable to you and me throughout the country. Again, different perspective. 7% inflation basically means today, if you have 1 crore and if you just put it in cash or savings account, it is actually after 20 years, it will be equal to 26 lakhs. So, basically value of money is depleting every day. And this is a basic chart that everybody should actually, memorize it very strongly. What is the benchmark for understanding this is a good enough return, bad return, or fair enough return? This is the benchmark. Inflation is your benchmark. And make sure you check post-tax returns. So if your investment product is yielding post-tax returns less than 7 to 8% per annum, so in your pocket, if you're getting 7 to 8% per annum, you're actually at negative real return, you're losing money. If your investment product post-tax is giving you 7 to 8% per annum, you are sitting at no gain, no loss. This is basically break even. And this is the place where everybody wants to be. They want their money to make money, a true wealth generation area where your post-tax returns are more than 8% per annum. So, this is basically the graph. This is really something that you should keep it as benchmark everywhere. And the secret to actually using it is a lot of times you're offered investment products that in 10 years your money will become 2x, 3x, whatever. Tell them I don't want 2x, 3x, or my 10,000 will become 20,000. Tell them in 10 years, if I'm parking my money, what is the return in percentage terms that I will get? The post-tax return in percentage term. As soon as you get that post-tax and return percentage term, you can just put it here, and then you can make out if it's negative real return or it's positive real return, or it's just inflation matching return. This is the easiest thing that you can do for yourself. Now, the most popular one, bank FD, that a lot of us, I'm sure, have a lot of affinity towards. So just to give you a perspective, if you were suppose investing 10 lakhs today in a bank FD and you're investing it for 10 years, and even if the rates are at 6% per annum, and I'm sure the audience that I'm speaking to is under the tax bracket of at least 20%, 30%. So that 10 lakhs in 10 years becomes 16.32 lakhs. Looks very good that, my principal is protected, and in 10 years, I've actually gained 6 lakhs. Now let's just compare it with purchasing power, or, how it impacts your expenses or inflation. How does it impact your money? Now, suppose MBBS cost today of your college fees is 10 lakhs today. After 10 years, the same college to offer you the same degree is going to cost you around 20 lakhs. And this is with a very conservative assumption of 7% inflation. In fact, education has an inflation of 8 to 10% per annum. But even having a very, conservative assumption of 7% per annum inflation, this shows that, your cost is going to actually double in 10 years, but your money has grown to just 16.32 lakhs. So a lot of people treat it as, guaranteed income, but according to me, if you ask me, this is actually guaranteed loss. Today, I was able to buy X basket of goods and services. After 10 years, because my money was in bank FD, my purchasing power reduced, and I was not able to buy the same basket of goods and services. So according to me, it's not guaranteed income, it's actually guaranteed loss. So bank FD is basically an illusionary product. It gives you an illusion that your principal is protected, your income is guaranteed, but actually what you're missing out is you're not comparing it to inflation. Your purchasing power is definitely going to reduce. It's a guaranteed loss of at least 1 to 3% per annum. So definitely it's a guaranteed loss. I'm not saying a complete no against bank FD. Bank FD again has its own place in financial planning. It is very important to have a bank FD, but you need to make sure you're investing the right amount. Bank FD, the thumb rule always is you should have 6 months of your monthly living expenses. So if you're today, your monthly living expenses, your grocery and all of those monthly living expenses are approximately 50,000 rupees per month, then make sure you don't have more than 6 to 12 months of your monthly living expenses. So max to max, make sure you don't have more than 6 lakhs in a bank FD. 50,000 into 12, that is 6 lakhs. Not maximum, you should have 6 lakhs in a bank FD, and that too as an emergency corpus. So in case of any emergency, medical emergency, or any uncalled house repair, or any kind of emergency, job loss, or anything of that sort comes up, and you can just take your money out from a bank FD without attracting penalty, without attracting any a lot of operations. It's very easy to access. It should be accessed overnight, and then after that is done, after your emergency is done, you can just replenish the emergency corpus again in the next 3 to 6 months. So this is the thumb rule for bank FD. Definitely, it's very important to have bank FD, but anything more than 12 months of your living expenses parked in bank FD is actually depleting your purchasing power every day, every year. What are the different investment options? Bank FD is very safe, very, it's a very comfortable investment option. I don't want to take a lot of risk. I understand, but there are a lot of other investment options where you're not taking a lot of risk. You just don't know the right way of investing, and you can actually at least match inflation rates. Now, how does an average doctor invest? A lot of us tend to rely on bank relationship managers, agents, and friends. So I'll just show you a tweet from a financial influencer. You can see at the blue tick, Deepak Shenoy. In November last year, he tweeted, "Dear bankers who are selling a pension ULIP to a 75-year-old, lying to them about returns and omitting facts that money is locked in for life. How do you sleep at night?" And to this, one of the bankers, public sector bankers, replied, "So I was also a banker a few months ago, and that too in a public sector bank. There was an insane amount of pressure for cross-selling products from upper management. And if you cannot meet the targets, you are humiliated in the meeting in front of all the colleagues." And one other banker replied, this is exactly why I quit my job. At a bank, I was placed at after MBA. I absolutely did not want to fool people and get paid for it. So, the entire motivation or the entire reason why a bank relationship manager is actually suggesting you an investment product is not because, it is inclined to your investment planning, but it is they have revenue targets or they have selling targets for that particular financial product. For example, ICICI Bank might have a financial or a revenue tie-up with products of HDFC life products, HDFC insurance products, or HDFC mutual funds for that matter. And that is why a lot of times you are actually sold products instead of understanding what is the right product for you. And this is the reason why we are here, to understand what is the right selection process or what is the right way to actually, choose investments for yourself. Then a lot of us actually develop a lot of comfort in what our past generation has already invested into. So my family has been investing a lot already in bank FD or PPF or in senior citizen savings scheme. Let me just invest in that. It's a short way. They did good, so I will definitely also do good if I invest in that, or real estate. But the ideal way is always missing. What is the ideal way? How should you actually go about choosing your investment asset class? How much to invest where? When to invest where? This is what we're going to cover today. So link your investments to your goal. This is the rule number one. Where should I invest my money does not depend on your age. In fact, it depends on the goals and the time to achieve it. So a lot of times people ask me, I'm 60 years old, Arpita, where should I invest my money? So your age does not define the right investment asset class. The rule, a lot of people of you might have read that rule: 100 minus age is equal to the amount you should invest in equities. The older you are, the lesser should be your equity portion. We are completely against this rule. The reason being, imagine an 80-year-old. So I'll give you an example of one of my clients. He's an Indian Army veteran. He's 80 years old. His kids are financially independent. Because he's an Indian Army veteran, his income is a pension, which is, pretty sufficient. In fact, he's able to save money out of that. And he doesn't have any financial goals left. And he's in fact able to spare money every month when his pension comes. And he comes to me and he says, Arpita, I have 30 lakhs. Where should I invest this money? Looking at my age, I don't know. I should just go for a conservative asset class. And to this, I asked him that, your 100 minus age rule says you're 100 minus 80. So basically only 20% should go into equity. But what my logic or what the financial planning rule actually says is that your investment decisions should be guided by the goals that you have. What is the financial goal? What do you want to do about this 30 lakhs? Do you need this even if you're alive for 10 years? He said, no, I don't need it. I just want to keep it with me. But, after me, definitely it'll go to my next generation. I'll pass it on to my grandkids. Even if I'm, alive for 10 years, I won't need this money. My medical insurance is in place. My daily needs are comfortably met with the pension that I'm receiving. I have other cushion. And that is why, and that is the logic comes in that, if your financial goal is actually inheritance. So I told him that, even if you know more tomorrow, your kids can still wait for 5 to 7 years to access this money. The money can be invested into that financial product. The name on the financial product can change from you to your grandkids, even if you know more tomorrow, but they can still wait for 5 to 7 years, right, to access this money. And he said, yes. And that is exactly this rule. This is where the rule comes in. Your financial goal, always the time horizon, and how much time do you need that money back? This is the only rule that defines where should you invest your money. And there are, asset classes for as low as 1 day investment. I need this money after the weekend. I have this spare money for 3 days. And there are asset classes for, investing your money for as much as 20 years. The basic thumb rule is a thumb rule of 5. If you have less than 5 years, you want to use this money in less than 5 years, ideally you should go for capital protection. Your capital protection is your priority, and you should compromise on inflation matching or inflation minus returns, because my priority here is capital protection. But as soon as you have more than 5 years in your hand, you should always try for inflation beating returns, high risk and probability of high return kind of investments. A lot of people ask me, I don't need this money, but what if I need it for an emergency? For that, create an emergency corpus that we talked about, 6 to 12 months of your monthly living expenses parked into a bank FD. That emergency corpus will be sufficient to take care of a what if moment. But whatever extra money, wealth creation, or any other money that you have, just try to create a financial plan map and ask this question, when do I need this money back? I'm parking 10 lakhs today. Can I spare it for 5 to 7 years? If yes, then definitely go for an inflation beating return and not defined by your age. So, whatever money that you're generating, either in terms of monthly cash inflows or any lump sum money that you have, try to bucket it into 3 buckets. One can be your emergency fund or short-term goals, any money that you need in less than 3 years. The second bucket can be, I need monthly income from this money that, I'm parking this corpus and I need a monthly passive income from this, or goals I need to achieve between 3 to 5 years. There's a different asset class for this 3 to 5 years medium-term goal. And the last asset class is long-term, wealth generation or goals to achieve after 5 years, they, time period for more than 5 years. Worldwide, by whatever name you call it, there are only 3 asset classes for this kind of a goal, wealth generation or goals to achieve after 5 years. There's real estate, there's equity in the form of stocks, mutual funds, small case, PMS, AIF, international equity, whatever you call it, passive investing, ETF, and gold in the form of gold, physical gold, or sovereign gold bond, or gold ETF, whatever you call it. But worldwide, these are the only 3 asset classes, in whatever name you call, for goals to achieve, or if you can park your money for more than 5 years. Now, one mistake that doctors tend to do is overexposure to favorite asset class. And the favorite asset class for doctors is no doubt real estate. And the reason they give is that real estate is an evergreen asset class. If I park my money, it will definitely grow. And hence majority of my money, I've seen doctors with 70, 80% of their money parked into real estate. Busting that myth, real estate is not an evergreen asset class. It also goes through cycles of ups and downs. In fact, very recently, we had a flat cycle of real estate from 2012 to 2020, when real estate markets were literally flat. There were no ups and no downs. In 8 years, real estate markets hardly moved. And if you're giving me that answer or rebuttaling me with that, 8 years didn't move, but 9th year, suddenly my property prices doubled. In 1 year, it suddenly doubled after 2020. Then it didn't take 1 year. It took 9 years to double your money. And if your money is doubling in 9 years, that means you have generated inflation matching return. So the thumb rule to analyze if your real estate has actually generated wealth or created money for you or created returns for you, the thumb rule always for that is in 5 to 6 years, your money should double in real estate. Or if it has taken around 10 years, then your money or your property valuation should become 4 times. This is when you've actually generated a return of 12% per annum, or 12% per annum, or inflation beating return, which is the ideal area that you need to be in. So in 5 to 6 years, it should double, or around 10 to 12 years, it should become 4 times of the money that you've invested, the portfolio valuation. I'm not again saying that don't invest into real estate. Every asset class has a place for your portfolio. Any money that you want to save for more than 5 years should go into this asset class, but make sure not all or majority of your money is into this asset class. Why? Cap it to not more than 40 to 50% of your money that you want to park. So if you have 100 rupees, out of that, you have 50 rupees that you can spare for more than 5 years. Make sure not more than 25 rupees is parked into real estate. Why? Because if your entire 50 rupees that you want to save for 5 years, and you get trapped, and I'm sure you all agree it's not easy to understand if this is a real estate up cycle or a down cycle. When it starts or when it is at peak, it is very clear, but it is very difficult that next year real estate will actually work, or next year is the last year, you should just book your profits, just churn your inventory. So it is very difficult to actually predict those cycles in advance and actually do the right actions. And that is why we always say not more than 40-50% of your money should be into real estate. Because if you're trapped in a down cycle, then if your entire portion is making hardly making any returns. And, it actually decreases your purchasing power substantially. If at least 50% of your other asset class, and real estate and equities are actually inversely proportional a lot of times. So at least one portion of your portfolio will be giving good returns. So it can pick up your portfolio return substantially. So again, this is called diversification, basically smart management of money. What about gold? Gold has recently given a lot of good returns, especially in COVID times, and currently also, it is amongst a lot of talks because of, war situations, China, US, again, tensions. So gold also is an asset class that goes through various cycles of ups and downs. Recently, we had a very good up run, but there was a big lag of, lumpy returns. So again, the thumb rule of gold is always an inflation matching return asset class when observed over a period of 7 to 8 years. If you will see 7 to 8 years, approximately in every 7 to 8 years, gold returns will be equal to inflation returns, inflation matching returns. So you can actually, a very interesting fact is 50 years back, if you ask your family that what was our monthly living expense, then you equate it to, maybe it was equal to 8 grams of gold. Today also you will see your, monthly living expenses is equal to current price, 8 grams of current price of gold. So that is why inflation is a very good, gold is a very good hedge for inflation, and gold returns over a period of 7 to 8 years is actually inflation matching. So approximately you can expect a return of 7 to 9% per annum over a period of 8 to 9 years. So again, what is the thumb rule for investing into gold? Cap it to 10% of your portfolio money. Third asset class, equities. What are the notions around equities? They're very volatile, especially after this, currently the sentiments are again okay because markets have gone up again. But if I would have taken this session 1 month back, the sentiments were really negative. The equities are very volatile. Stock market is volatile. It's like gambling, very time consuming. This is a lot of things that I hear when I talk about stock markets or equity. They're very risky. I don't have the time. I'm a working doctor. How do I manage my money? I don't understand this asset class. So equities or stock market is volatile in the short run. You monitor it on a daily basis, weekly, monthly, yearly, whatever. And a lot of macroeconomic factors. COVID happens and you could not have predicted such a big event, and markets crashed. General elections, subprime crisis, euro crisis, demonetization happened. Nobody could have predicted that. So all of these things happen, and markets just respond suddenly to that, and it's very difficult even for professionals like us to actually predict such events. So equity is volatile in the short run, but in the long run, equity returns are in line with the growth of the underlying economy. What we did was, in the last 30 years, we observed how have the different asset classes performed if you would have just invested and slept over it. During 79 to 2019, inflation in India was around 7% per annum. During the same time, bank FD rate was 8% per annum, minus taxes. Gold during the same time was 10% per annum minus taxes. During the same time, stock market, Sensex, equity gave a return of 17% per annum. So by a big substantial margin, beating other asset classes and inflation. So, equity, that is why we always recommend it is a long-term asset class. And by long-term, I don't mean 20 years, 30 years. If you have more than 5 to 7 years, if you can stay invested for 5 to 7 years, equities or stock markets is a very good asset class, and a return of 12% is very, very achievable when you stay invested for 5 to 7 years. And this is how I can show you actually. So this is a very interesting rolling return graph that in the last 10, 15 years, if you would have invested on any date and stayed invested for exactly 2 years, a lot of volatility, you would have come out with maybe plus 26% per annum return, or even with minus 10% per annum return. So a lot of unpredictability, a lot of volatility. As soon as you increase your time horizon to 7 years, in the last 15 years, 10, 15 years, if you would have invested on any date, lucky date, unlucky date, market expensive date, market cheap date, you would have invested on any date and stayed invested for exactly 7 years. Even in the worst time, you were sitting at plus 5% per annum. So this is after COVID market crash of 30%. You can see the market crash of 30%. Even after that, even if you were the unluckiest investor, your 7 years ended on the worst market bottom date, you were still sitting at plus 5% per annum, which is really good. The highest was, of course, 14.5% per annum, and a return of around 12% was very, very achievable. So, your downsides are really capped. You don't have capital you don't have capital risk. There's no capital risk. There's definitely a plus percent, and that too plus 5% per annum, which is really good. So that is why I say, whenever you're investing into equities, don't put a lot of brain into timing the market, but coming back to a rule always, which is very popular, time in the market is more important than timing the market. So time, basically, at least 5 to 7 years, if you have in your hand, even if you're entering at the wrong time, it's very, very comfortable to actually get 12% per annum kind of returns. But when I say 12% per annum kind of returns in 5 to 7 years, this is what investors expect. Every year plus 12, plus 12, plus 12, plus 12. But what actually happens is plus 8, then minus 14, then plus 48, then minus 3. So a lot of ups and downs. And after 5 to 7 years, the average comes to 12% per annum. So you can't check your returns every day, every year to be plus, plus, plus. A lot of times it will be negative, and a lot of people after 2 years come out with a bad experience that, it's been 2 years. How long do you want me to stay? And, they come with a bad negative experience and lose money and they never come back. But you have to stay invested for 5 to 7 years, and a return of 12% per annum is very achievable. What are the ways to manage risk or volatility when you invest into equities? One is, we just discussed, stay invested for at least 5 to 7 years. Number 2, diversify across stocks, sectors, and market caps. Number 3, take professional institutional advice, not professional advice, just like talking to a RM or a local HDFC securities guy. They're not professional institutional advice. Professional institutional advice is, working in alliance or making an investment strategy similar to big institutions, and that is possible. And then Rupee cost averaging. There are a lot of ways to invest into stocks. One is you can just go and pick your stocks. The other is invest via mutual funds or small case or PMS, EIF, whatever, passive funds, ETF, whatever. This is one thing that I would, recommend to a lot of people, that if you're keen on investing and picking your stocks by yourself, or, through your HDFC or ICICI Securities, Kotak Securities guy, just do one thing. If you're investing 1 lakh, invest 50,000 here and invest 50,000 here. After 5 years, compare the returns. 95% of the times, the returns are higher here. 95% of the times, people investing in stocks are making lesser money than made money during the same time by investors in passive funds or Sensex or mutual funds or small case or PMS, because this is professional institutional advice. And here, to actually earn more than this, there's a lot of experience and maturity required to earn the higher returns. 95% of the retail investors are better here. For the uninitiated, what are mutual funds? Mutual funds are basically, when a pool of investors, they pool their money, they hand it over to a fund manager. That fund manager then invests into a basket of stocks, a basket of 50 to 100 stocks. And then whatever return is then generated, it is then delivered back to the investor. There are a lot of equity mutual funds offered by big financial institutions. Like today, more than 40 financial institutions have equity mutual funds, like Kotak, SBI, HDFC, ICICI, a lot of them. SIP is a very efficient way of investing into mutual funds. A quick briefer about all of these basic terms for the uninitiated and for people who are just new to this. So SIP is basically a fixed amount is deducted from your bank account, and it is periodically invested in the mutual fund portfolio of your choice. So SIP is basically reverse of EMI. Every month, how EMI your money is deducted from your bank account and it is used to pay the loan. The same way, SIP money every month, fixed amount is deducted from your bank account and it is invested in a portfolio of mutual funds. What are the advantages? Number one, it's simple and convenient. It automatically happens. It imbibes a automatic saving habit in me, so I don't have to write a check every time, or I don't end up spending that money. It is automatically deducted from your bank account. And number 3, rupee cost averaging. You're investing at all levels in the market. If markets are today expensive, I still invest. If markets are cheap, I buy more, but I still invest. So I'm investing at various levels, and my buying cost is averaged. And this is a very interesting study by Crystal. Crystal did the study that, an investor who does an SIP of more than 5 years, the probability of negative returns literally reduces to 0. So if you've done an SIP of more than 5 years, in the last 15 years, none of the investors have actually come out with a negative return. So again, coming back, try to invest via mutual funds, PMS, AIF, small case or ETF, passive investing, whatever. Stay invested for 5 to 7 years and invest via SIP for all of this duration. This should be actually your priority number 1, creating a second source of income. And this is, I strongly recommend to all the doctors, all my audience, because when I speak to a lot of doctors who are around 50, 60, because the profession is so mentally, physically, emotionally taxing, they all want to slow down by the time they're 60 years old and take only selective cases. And that is when you want your monthly living expenses to be completely covered by a passive income that you're generating. So passive income that is being generated, that completely covers your monthly living expenses, and you don't have to depend on your medical income. And for that matter, I won't say you should wait for 55, 60 to achieve that level. The sooner you achieve that level, financial freedom level, that you're not depending for your monthly living expenses on your medical income, but a passive, a rental kind of income is coming from your financial instrument. It creates a lot of financial freedom, a lot of happiness, a lot of freedom at work, and a lot of enhanced creativity and productivity. How do you do that? Number 1, try to create a corpus within 10 to 15 years. If you're starting from today, or if you've already started, calculate the amount and make sure you don't exceed more than 20, maximum 10 to 15 years. If you're 30, make sure you have this corpus or passive income generation started from 40, 45, when you're 40, 45. So you'll really see the impact. So then you're working for other bigger financial goals in your life. How do you do it? Number 1, you need to calculate the corpus required, which is different for everyone. It depends on your standard of living, and it depends on your age. There are a lot of calculators available online, or you can come to us, we can help you do that. Number 2, start a monthly SIP in equity mutual funds, sufficient to reach. So just, do a back calculation and calculate what is the SIP that you need to reach this corpus in 10 to 15 years. And whatever SIP that you start in 10 to 15 years, you achieve that corpus, and after 15 years just park it into a hybrid mutual fund and create a monthly withdrawal plan, systematic monthly automatic withdrawal plan, so that every month, like a salary, automatically your bank account is being credited with your monthly living expenses that you need, and it is inflation adjusted. So today, if I'm receiving 50,000 rupees per month, next year I should ideally receive 50,000 plus 7% to take care of the inflation or rise in living costs. I'll just show you with an example. I'll just share my screen and show you with an example. What we did for one of our clients, strong recommendation, to do it for yourself also. It's a simple exercise. Either you can do it yourself, or if you want more peculiarities, you can actually, we can help you do this. So this is something that we created for one of our clients. She was basically a widow, and for her dependents were her mother-in-law and her daughter, whose education and medical marriage expenses she had to take care of, and of course her and her mother-in-law's retirement corpus. So number 1, we checked out what are the debts that she already has, home loan kind of things. Does she have an emergency fund already intact? Then what kind of insurance does she already have? Does she have a life insurance? Does she have a medical insurance? What are the current investments that she has? And after that, we figured out what was the monthly income or monthly passive income that she needed. So, in the first year, she needed a monthly annual living expense of 4,16,000. And this income should ideally increase by 5% or 7% every year to incorporate the rise in inflation. With that, we did a back calculation and we figured that she needed a corpus of 1.4 crores. So she needed, and this is the inheritance money or insurance money that she received when her husband died. So we suggested that, park 1.4 crores into a hybrid mutual fund. In the right category. Again, hybrid mutual funds, there are 5 categories. So make sure you have the right mix and park it into our suggested investment portfolio so that the first year you can withdraw 4,17,000. And you see the amount that she's going to withdraw every year is actually increasing by 5%. So in the 12th year, she's actually withdrawing 7 lakhs to take care of, again, inflation. So this is inflation adjusted. And this is going to be there even if she's alive till 95. So this completely covers for her basic standard of living that she wants to maintain till eternity. And then, other financial goals. We came to other financial goals and we figured that, she had to take care of her daughter's education and marriage. We calculated what were the amounts, what was the expectation, what was the amount that she wanted to spend, factored into inflation. And then that is how we did a calculation that she needed to invest 30 lakhs today to take care sufficiently of her expectations of her daughter's education and marriage. And, this was the total. She received the corpus of 2 crores on, her husband's demise. And this was the allocation that we suggested to her that, if you have 2 crores, park around 1.5 lakhs into a bank FD or a liquid fund to take care of, all your monthly living expenses or emergency fund. And then, we explained to her that, this is the amount she needs to invest into for her daughter's education, daughter's marriage, X amount, 1.39 CR for her passive source of income. So, instead of just randomly reading paper and, figuring out, let's invest 10 lakhs here, or this is a new financial product, let me invest here. Ideally, create a financial plan or financial map for yourself. Understand what are your financial goals, that I want an emergency corpus. These are my financial goals. Quantify them. In how much time do you want to achieve those goals? It's a one-day exercise. It might seem daunting right now, but it is something really important and actually can make your money really efficient, grow efficiently. And then invest in the right asset classes and bucket your expenses like that. Okay, I'll just come back to our presentation, original presentation, just a second. So, some little things, final things about winning at money and actually making the right investment decisions. It is mainly about 80% behavior, emotional behavior, and only 20% knowledge. So, this is one thing that we asked, and we did a survey, nationwide survey for all the doctors, and we asked them, what did you do of your investments in stocks or equity mutual funds during the COVID market crash? Did you sell it? Did you stop your SIPs? Did you not do any changes in your investment strategy, continued as it is, increased my exposure substantially, or was not investing? So this is what Doctors Pan India did. 40% of the doctors during the COVID market crash continued their investments as it is. 40% were not investing into equity markets or mutual funds then, hence not applicable. And 10% were different other options. I'll tell you what we did for our clients. Our clients, what we did was we preponed their SIPs or increased their investments amounts. What did we do was basically, if our client had an SIP of 1 lakh per month, so in April we told them that markets have become really cheap. Let's prepone your SIPs. If of course cash flow is permitted, that instead of investing 12 lakhs in 12 installments, let's just prepone them and invest the entire 12 lakhs in the next 2 to 3 months, just stagger them. And because the markets are really cheap, let's just invest this 12 lakhs, prepone the investments instead of continuing or not making any changes. The right way was, if the markets are really cheap, just aggressively increase your investment amount. And we invested that money. And a lot of people were actually ended up saving a lot of money because expenses had also, fallen down sharply. So we encouraged them, we helped them understand the economic situation, and that, it was a very good investment time actually. So we preponed a lot of our clients' SIPs and increased their investment substantially into equity during the COVID market crash. So investing at the right time, definitely, and in the right pockets. Majority of the people during the COVID market crash were actually investing into Nifty 50 blue chip stocks, or those HDFC Bank or Axis Bank, or not Axis, sorry, HDFC Bank, Maruti Suzuki, Asian Paints, all of these big blue chip Infosys, TCS companies, which were really cheap at that time. Versus what we did for our clients was we invested that money into small cap stocks. And you can see the difference of actually double. If you would have invested during COVID market crash in Nifty 50 or Sensex or passive funds or these blue chip stocks, you would have been sitting on 30% returns. But we realized the opportunity was actually in small cap stocks, and we made our clients. And I can actually show you, PDFs with our clients actually sitting at 60-70% kind of absolute returns in less than 1 year, 60-70% kind of returns sitting on, and we booked that profit. A lot of people thought because it's a medical pandemic, healthcare stocks will do good, but actually healthcare stocks just gave a return of 18%. So, investing in the right time is important, but understanding where the opportunity lies is equally important. So this is something that you need to make sure that you're investing in the right pockets. The second question that we get asked frequently is index investing. What is our view? So we always say passive funds definitely included in your portfolio, but do not limit to it. Add index beating components also to your portfolio. What do I mean by index beating? Number one, there are a lot of mutual funds, PMS, which are consistently beating the index. Try to figure out those, or hire an agent or investment advisor who can help you figure out those asset classes and invest in that. Number two, asset allocation, which I just showed you. Understanding where is the right opportunity, where is the opportunity, like we spotted the small cap opportunity and we helped our clients invest that money, and then you can actually gain an alpha or gain an edge in your portfolio returns. And number three, try to take 10-15% of your sectoral bets. Definitely only if you either are an expert or you are working with an expert, this is recommended. Does it really make a difference? Should I really try to add index beating components to my portfolio? It's a lot of effort. Isn't just passive fund investing really easy and the perfect way of investing? So passive can generate you 12%, but adding index beating components can actually help you generate a return of 15-16% per annum. Does it create a difference? This is the kind of difference it creates. SIP of 25,000 per month in a passive fund can generate a return of portfolio value of 2.5 crores. But as soon as you add index beating, you have a conscious decision of adding index beating components to your portfolio. If you're generating 15% per annum, just a 3% return can actually add 2 crores to your portfolio value. So this is the power of compounding. This is the power of actually adding index beating components to your portfolio. What are the current Indian equity market valuations like? So our general perspective or general idea about the market's position right now is our long-term view on Indian equity is really, really positive because of PLI, and a lot of economic factors are really positive and in our favor. But in the short term, we see a lot of volatility because of geopolitical tensions. There are Fed rate and all of these risks also hovering, inflation risk, US recession fears, all of these issues are hovering. And honestly, we consider markets not to be cheap right now. So if you are an SIP investor, or if you have excess monthly cash flows that are coming, go forward. If you can stay invested for 5 to 7 years, continue with the SIPs. If you have lump sum money, there are two options. What you can do is, number one, I would not recommend, honestly, I'm not of the school of thought that, just invest your money right now. I would say just stagger your investments over the next 6 to 9 months. According to me, Nifty around 16,000 is reasonably valued. Currently, we're a little expensive. I'm not saying we're very expensive, but I'm of the view that, don't invest right now. Don't be greedy, or don't come into that, fad or just run that, let's just invest money. Markets have started going up. Markets are expected to be volatile in the next 6 to 9 months. So it's okay. Markets might come back again. Of course, I'm not 100% sure. We can just predict, but it's a very high probability that markets might give you better valuation. So stagger your investments and try to invest around when Nifty is around 16,000. Stagger your investments. And this is how you can actually do your equity market strategy. So this is the last thing that we're going to cover today for today's session, and we'll open for audience Q&A, just last 5 minutes for my presentation. This is something really, really important. This is the last slide, last few slides, but really, really important, because a lot of doctors end up making a lot of mistakes into insurance. Number one, explainer about what is a term life insurance. Basically, term life insurance or term plan or whatever you call it, it's basically, if you know more tomorrow, this is the money that your family will get to take care of the financial responsibilities that you've left behind. For example, retirement planning of your spouse or your kids' education or marriage. So this is really, really important for every earning member in the family. So if you and your spouse are both earning, have a separate term plan for both of you. Do not have it for your dependent parents or dependent kids. What is the insurance coverage that you should have in a term plan? It should be 10 times of your annual income. So if you're earning 10 lakhs today, make sure insurance coverage is at least 1 crore. The biggest mistake that people or doctors tend to do is they don't opt for the most basic plan. Opt for the most basic plan, and if you're actually going for a term plan for around a 1 crore or 1.5 crore insurance coverage, it'll be really cheap, as low as 10,000 to 30,000 rupees per annum. The mistake that we end up doing is get attracted by those fancy riders that our agents offer. Accidental cover is important, but money back policy and all of that, try to avoid that. These are just ways of actually getting more money from you and your agent earning more from you. Just go for the most basic plan. It will be really cheap, very, very affordable, 10 to 30,000 rupees per annum. But this is really, really important. Now, this is one thing that I've seen so many doctors have a lot of money parked into: guaranteed return plans or pension plans. What they offer is, they say that, pay a monthly premium or an annual premium every year for 10 years, 15 years. And on your retirement or after 20, 30 years, you will get 3 times or, X times of your whatever money that you've invested. So if you invested 10 lakhs through the year, you will get, throughout your premium payment, you will get 30 lakhs, or you will get a monthly guaranteed pension after you retire till the time you're alive. So it looks like a very attractive marketing plan that, I'm doing something for my retirement. But actually, when you see inside the package, it is basically a bank FD. When you actually calculate the returns and ask your agent that, what is the return in percentage terms that I'm getting? It is not more than 5 to 6% per annum, because it is guaranteed. It is a pension plan. It is 5 to 6% per annum. And we just saw that 5 to 6% per annum is similar to bank FD, and this is where your purchasing power is decreasing substantially, and it is a guaranteed loss product. Number 2, it's money locked in for a long duration. So basically, it's a creatively marketed product, essentially a bank FD at low returns. If you want to stay invested for 15, 20 years, you might as well invest in the 3 asset classes that we discussed. Why do I pay my agent so much money to actually market or sell me a bank FD just in a creatively marketed product? So strong recommendation, please do not buy those plans. If you have, try to surrender them. These are just money making machines for your agents. And number 3, the last slide for today, is ULIPS. ULIPS are basically insurance cum investment plans. And as a thumb rule for investment and financial planning, we always recommend, please do not never combine your insurance and investment. Have separate financial products for both. Number 1 reason is they're very, very expensive. Their costs are almost 3 times of the cost of mutual funds. So, very expensive on your pockets. Number 2, they say insurance and investment. The insurance component is completely useless. It is extremely, extremely underinsured. It will hardly, take care of any of the financial responsibilities your family that you're leaving behind. And number 3, there's penalty or charges on discontinuous. There's no flexibility. ULIPs are extremely missold, with the reason being they're the highest commission product for relationship managers or agents. And that is why ULIPs are, most missold products, and especially to doctors. So strong recommendation, if you already have a ULIP, try to sell it. You can actually, reinforce what I'm saying by reading it online. Should you buy ULIPs? On the cover, they might say ULIPs have become cheap, but actually when you see, they charge you expenses in various names. If you see 2-3 names and you add up those costs, it'll come to 4 to 6% per annum. And it is really, really expensive. And if you read the policy terms, they're really deterrent to your money. So, as a financial rule, always keep your insurance and investment separately, and you can actually do really good with it. With this, we can end the session. And, this is a small education initiative by us. We have a free WhatsApp newsletter wherein we try to educate all our readers with, money IQ articles or smart money making, smart money, efficient money decisions. We do blogs, videos, all of these. You can just save this number 9111006340 in your contacts and send *0, and we'll add you to our WhatsApp newsletter. The frequency is not more than 2 times a week. In fact, it's even lesser than that, to be honest, but this is the max 2 times a week. And completely educational articles, blogs, or videos, or interviews about financial or money decisions in jargon-free English simple language, which will actually help you in betterment. So you can just save this number and you can actually join our newsletter. With this, we can end our session, and we can open for audience Q&A if the panelists can help us, take audience questions, and we can address those questions. Dr. Bijlani and Dr. Kale, over to you.
Yeah, Arpita. Hi.
Hi.
Yeah, very nice lecture. Like most of the people always give more boring descriptive lecture. Nice lecture by giving some examples. Really, today's lecture, I think so. For me, the highlight was the inflation, because many people don't take that in consideration for the investment. And the other thing, 2-3 things which I really liked about the lecture was inflation, then keeping a gold as a hedge for the inflation. And second thing, like still there is like myth, or I don't know, as the age goes on, you should not put on the equity, like go more on conservative. So you can just highlight that point a little bit if possible, like because we doctors, like the first 4 decades are gone in studies only, and then we start earning, and then really our favorite class is the real estate. And still though people are improving in last few years, what I feel, but still the real estate is the most of the doctors' favorite asset. I feel you can highlight on that point.
So, I would always strongly recommend, just don't read about any financial product and just take a decision to invest into it about anything at all. What I showed as a sample financial plan, try to create that for yourself, and you yourself will be able to take better investment decisions. You yourself will know that, 10-20% of my portfolio, I need this money back after 5 years. So let's just try to beat inflation with it. Now, how can you beat inflation? You can ask all those questions yourself. It's either real estate or equities or gold. So, that is how you can actually take the right investment decisions instead of just, simply, it's a very simple thing that 100 minus age kar lete and let's just invest money. Don't go for shortcuts. Just create this, financial plan. It will take a day or maybe a max a week. Just speak to an expert. We can help you do that. But, this can actually create much better, efficient money decisions for you. So at least you won't be trapped into low yielding products, or even for that matter, a lot of people might be taking a lot of risk also according to their appetite. So this will help you in taking the right amount of risk, not more, not less.
The other thing I really appreciate of the lecture was like the common message, simple, the ULIP, especially the term plans. I should not use the word LICs and all that, because maybe our time, 10, 15 years, 20 years, but the LIC was the main insurance, and people used to take insurance, and now we realize that actually we are losing money rather than gaining money.
So a lot of people still tell me, I speak to when we do client calls, I ask them, why do you have this? So they say that, we've always heard LIC to honi chahiye. But, LIC also has a lot of products. Make sure in LIC, you just have a term plan. You're not going for the guaranteed plans or, those pension plans, because they're again, because it's LIC doesn't mean it's the right thing for you. The right thing is basically, just go for a term plan and keep your investment separate. Don't go for any word. If it is giving you guaranteed, it is basically inflation minus return or, negative real return products. So put a little brains, don't go for shortcuts ki LIC to honi chahiye. Put a little brain ki yaar kyun honi chahiye? Is it really worth it?
One more thing which I looked at your slide was that you did a smart investment predominantly, especially in the small caps you said. I know it is nice to earn, but sometimes the small caps can be really dicey also. What I feel is, I'm not expert in that, but at least it could be dicey means like sometimes we always think the large cap or top 10 or Ritik stocks, what we talk, are really the good for the investments. But then small caps, like how you decide? I know it is very vague question or maybe a very broad question, but a roughly idea on that.
Okay, so very good question actually. How do you understand what are the right investment opportunities? This comes with a little experience. So either if you can either be an experienced investor or an avid follower of the market, or avid follower of the economy in general, or just be with a investment advisor who's actually educated about all of this. And you can actually make such right decisions when you're actually doing this. It's very evident. Like currently, if you ask us what are the sectors that we're bullish on, is banking and financial sector. Then there's capital goods. We've been preaching about capital goods since the past maybe 8 to 9 months. And if you see 8 to 9 months, capital goods have vastly outperformed benchmark capital goods stocks like Schaeffler and ABB, Siemens, such simple stocks, but they've given such fabulous returns because they're capital goods stocks. So these hints are very evident when you listen to the budget or you read the newspapers. But either that is why I would always recommend that either be an avid follower or invest with a person who is an avid follower, who's not just investing according to the commissions or their sales target, but who's actually an investment advisor.
Okay. Little question. Syllabus, like, is the taking a 52 weeks high stocks, predominantly good mid cap or large stock, is it advisable or shall we
These can be just filters.
Okay.
But at the end, if you're again picking on stocks, as I said, that make sure you invest. If you started doing it, make sure 50% is invested into stocks and 50% is into passive funds or mutual funds. And after 5 years, you see if you're doing actually making more money than those passive or mutual funds. And 95% of the times people don't. It's just a thrill or an adventure ride that you might be enjoying. But if you've generated 30% per annum in the last 2 years, see if Sensex has already given a 40% per annum kind of return. Then again, you're thinking you've made 30, but actually, if you ask me, you would have not done anything and you would have gained 10% more.
So you suggest the SIP has to continue and it is definitely going to give a long-term returns for more than 5 years.
Yes. Investing is a very boring activity, but people try to make it very adventurous by doing a lot of experimenting. Just make it simple, 5 to 7 years. Start with basic mutual funds or passive funds or whatever. Strong recommendation, active index beating funds, add those components, and stop putting a lot of brains. Either do it yourself or outsource it and just follow the basic thumb rules and you'll be good.
You said maintain discipline, patience, and the results will be there.
Be boring.
Yes, Neeraj, you can.
Yes. So a very good talk. There are 1 or 2 questions from OrthoTV viewers. I would put it up here. Mm-hmm. Question number 1 is that there are a lot of senior doctors who also watch our channel. So who are basically either 55, 60. So what is the recommendation for them? They feel that, especially my mom now, she's 70. She says, I'm ready to put in mutual funds. What is the main question? Jisme mere ko nuksan nahi hoye, wo wala bata. So that is what she always says.
So if you're staying invested again for 5 to 7 years, we saw कि last 15 years में किसी ने भी 7 साल के तक पैसा रखा है तो किसी ने भी नुकसान नहीं लिया है. And this is the stat that I showed to you, that in the last 15 years, even if you invested on the market peak and you withdrew when the markets were at bottom, you were still at plus 5% per annum. So if you follow the basic rules, नुकसान नहीं होगा. You just have to stick and don't panic. कई बार क्या होता है कि market bottom होता है and we start looking at -12, -20% returns. But you said in the beginning that you can stay invested for 5 to 7 years. Stick to that. If you stick to that, there's extremely less probability. I'm not saying guaranteed, but extremely less probability that you lose on your capital. In fact, it's plus 5%. We just saw the real stat.
And so for a basically, like, what is the recommendation that percentage wise, it could be vary from personality to personality, I understand. Say, for example, if I'll just give you 3 case examples. So a doctor who's around 45 years old, a doctor who's 55 years old, and a doctor who's 65 years old. So what will be the recommendation? Equity versus debt versus real estate versus gold, whatever, versus crypto or whatever high risk investments. So what will be the ratio that you would advise them to have?
See,
versus real estate?
we are Nivesh Mitra particularly is a school of thought that we believe very much onto customized investment portfolios. Like if I ask you that, what is the cancer remedy for a 30-year-old or a 40-year-old or 50-year-old, you will ask me, what are the comorbidities? What is the particular type of cancer? How does the body respond to it? You don't have a fixed jacket formula for that. The same way, there's no fixed jacket formula for that. A general thumb rule is create a financial plan. The one that I showed to you. If you can create that, just take a day, maximum a week, it won't take longer than that. Just create a simple Excel sheet. These are the financial goals. This is the money that I need. And this is the amount of time I need in that much time I need that money back. And you will have your answers back. In less than 3 years, go for debt products. 3 to 5 years, go for debt plus equity products. If you have more than 5 years, go for equity. So again, depends person to person. That 50-year-old might be, if he's financially leveraged or he's, has a lot of responsibilities or loans, then different assets apply to him and different asset allocation is the right thing for him. So this exercise is really, really important. Try to go for customization, and this can actually generate better returns or better efficiency for you.
Okay. So, because what I had heard is that for a younger person, it has to be more equity, less debt, less real.
I challenged this in the presentation. Right in the beginning, I challenged this in the presentation that we are the biggest investor, Peter Lynch. He's a very big investor of USA, and he himself in his book has challenged that, we don't believe in 100 minus age rule for equities. It is always dependent on the financial responsibilities or financial liabilities that you have. An 80-year-old client that I spoke to you, he's an Indian Army veteran and his 30 lakhs he's deployed with us. He's completely invested into equities. Why? Because that money is for his future generation. He doesn't need this money. If he doesn't need this money, this is inheritance money. Why should he be conservative? Why should he invest that money in bank FD? So go by basic logics. Don't go by these 100 minus thumb rule, 100 minus age thumb rule. I'm completely against, honestly.
Okay. And how easy it is? Tell me one thing now, because you talked about future generation, how easy it is for someone to inherit the stocks in today's technology world? Very
easy. Your nomination, if it is in place, then it is extremely easy.
No, but I have heard that there has to be a will also, and then there has to be a succession certificate also.
Nomination is good enough. And at the end, of course, will supersedes. So what a lot of people do as a safety net is they can just have it in a joint holder name, joint account name. A lot of people have it in a joint account name with their spouse. And that is the easiest way of inheritance. There is no dispute, nominee, will, nothing exceeds that. Just have it in your joint name with your spouse. Or if your spouse is no more, just have it in a joint name with your child. Nobody will be able to challenge it.
So a joint name demat account and a joint name mutual fund account or whatever, that is the best.
That is the best. Nothing can beat that.
Neeraj, one more question for Arpita. As she has told that gold has to be the hedge for the predominantly for the inflation. Like any recommendation like how to diversify this gold, like any stocks or something like, or mutual funds or some bonds?
See, gold, honestly, the best way is sovereign gold bonds because they're tax-free. So sovereign gold bonds is the best way. Tax-free and very efficient. The second way is gold ETF or then physical gold. Top is SGB, definitely.
Okay, Sachin, I think this is the time we have for today. Thank you, Arpita. Thank you for thank you for pointing out most of the mistakes which the doctors make, and thank you, Sachin, for being there as a panelist and asking the right questions to the right speaker. So with this, I sign off. And if anyone wants to stay in touch with her, her number is there on the WhatsApp, and you can join their free newsletter where you'll get more financial knowledge. Thank you, everyone, for being there with us on OrthoTV, and see you next month again on the Financial Friday series. Bye-bye and good night.
Thank you so much. Thank you.